equities markets in the region. It was a bearish view across markets in West Africa, starting with the BRVM 10 index, which closed trading at 209.47 points, down 1.57%, while the BRVM composite closed at 201.49 points, down 1.3%. The currency for the region is trading at 493.85 CFA francs against the US dollar, taking its year-to-date change to 1.1%. And in Ghana, the GSE Composite Index closed at 2,004.75 points, down 0.33%, taking its year-to-date change to 67.1%. The GSE Financial Stock Index closed at 1,693 points, down 0.56%. The year-to-date change for that index now stands at 63.7%. And in Nigeria, the All-Share Index recorded a marginal loss of 0.03%, closing at 35,851.3 points. The year-to-date change for the index now stands at 27.6%. The major losers on the bourse were Owando, Access Bank, Verno, IHS, and NACO, while the gainers included Just Breweries, Transnational Express, Red Star Express, Champion, and Thomas Wires. For an outlook for the Nigerian equities market, I'm now being joined in the studio by Femi Olade, a partner at Argentile Capital Partners. Thank you so much, Femi, for joining us. Now, I'm looking at the market indicators for yesterday. More numbers still look quite depressed. Volume just 184.7 million shares valued at 1.9 billion. But we did see a focus on brewery stocks yesterday, Nigerian breweries, Champion Breweries, and Just Breweries. Is this a bandwagon effect, and it coming from Just Breweries?
There is obviously a bandwagon effect. We've seen Guinness's numbers, which obviously had been showing a declining trend across quarters. It's obvious that the consumer market that has driven most of the growth in the non-banking sectors has started to slow down dramatically, and it's perhaps something we have expected with the move from the CBN in the last 12 months, basically significantly tightening liquidity in the market. That was definitely going to start to impact on the consumer sector, and the implication of that is you're going to see quite a bit of pressure on some of the big players in that space. Interest rates continue to trend slightly upwards. Yesterday's overnight numbers were in the 60s in some instances, and I think that you're going to start to see that also impact on earnings going forward. Guinness's numbers, for example, showed interest costs rise dramatically from 2012 numbers. I think that what we're seeing in the market is basically the impact of all the tightening that we've seen from the central bank. There is usually a lagging effect on when the CBN moves and when we start to see that trend into numbers. There's usually a 6 to 12 month lag effect, and I think that's what we're starting to see drive numbers coming out of the market.
Because I'm imagining the investors thinking to themselves, where do we go? I mean, usually we know that in the banking sector that accounts for a large percentage of the trading volume on the market, and then apart from that, investors will naturally look to the consumer goods and industrial goods. Now there's pressure because nobody knows what kind of interest these companies are going to have to face with these banks, with the new CRL environment that we're in. So where can they take cover, or where else is there value?
There is still value in the market. I mean, there are a couple of things that we need to take into consideration. One, we've seen a strong rally in the Nigerian market. Indexes traded from 20,000 in 2010 to 37,000 today. So we've seen numbers that have been quite strong.
Yeah, but that was before the CRR. Now
which is true. But so what we're seeing now is more portfolio realignment. If you look at a Guinness that's trading on a forward PE of about 31, that's quite expensive relative to the industry where it's trading, as well as relative to the market. And I think that's what we're going to see investors start focusing on. With the death of new numbers coming out, we're not expecting to see Q3 numbers from anyone until well into October. Investors are basically going to focus on information that's already in the public domain. So you see companies like Owando declined slightly yesterday, driven by the news coming out of the UK. So investors are going to basically react knee-jerk in some instances to information that becomes available in the market, and you're going to see that drive the market going forward. I don't expect that we're going to see significant movements in the index over the next couple of weeks, simply because until we see the clear direction from the central bank next week.
Perhaps until the market receives the Q3 numbers, because it looks like there's a wait and see.
Exactly.
Let's see.
The market is basically playing wait and see. So what you're saying now is more portfolio realignment. People basically just rebalancing their portfolios as a result of moves in prices that may have impacted on the index. But the equity market, I think, will be very slow. We are placing quite a lot of attention on the currency market at the moment, even with all the effects of the central bank's intervention in the interest rate environment and all of the markets. There's still a lot of pressure on the Naira. We're placing quite a lot of emphasis on that going forward, because we think that if you look at the way the MPC has naturally reacted, the MPC has used the currency inflation and the available cash in the market, probably your M2, as the key drivers for the direction for interest rates. And I think that that's still going to continue to play a significant role. Now, inflation is benign, as we've seen numbers coming out. My expectation is that we'll still maintain single digits till the rest of the year, for the rest of the year. With where interest rates are, I don't think that there's going to be a lot of spending in the market, and the CRR as well is going to ensure that interest rates continue to remain high. And I think that that's one of the things that we need to pay significant attention to.
So all of that
forward.
doesn't exactly paint a very pleasant picture. It's still a bleak picture anyways. But then I guess, the wait and see, like I said, the wait and see attitude is still on. There's a lot of hope in the markets, especially for the bank Q3 numbers. Perhaps, the banks could surprise the markets, if they come up with better than expected numbers. But, we don't know if that's going to be the case. So we're going to see this lull continuing. And then after then, would there be like a very dramatic realignment in portfolios? The key driver for this market going forward has got to be new money. And I think that's really what's going to drive the market. Now, what would bring new monies to the market is obviously strong performance from the underlying corporates, or the belief that valuations are cheap. Well, can they have strong performance in the face of this interest rate environment? I
guess we both know what the answer to that is. It is a challenging environment for any business. And look, for me, I think that we've had strong growth over a 2-3 year period across the board. From a strategy point of view, you start to look for businesses today that are focused more on the future. What are the key drivers of consumer patterns going forward? How do you ensure that consumers continue to consume your products? In an environment where the consumer is becoming more aware, the consumer is becoming more discerning about how he spends it every Naira, then the question for me is, from a portfolio point of view, I'd want to stock my portfolio with those companies that generally can see those trends, those changing trends in consumer patterns, and be able to react to those trends.
Or realign
the strategy to consumer behavior. And I think that's the key driver. The banks, for me, the banks are always going to have it easy. If you don't take too much risk as a bank, with a differential between interest rates, you've got lending rates and they're way high in the 20s. Interest rates from a deposit point of view have trended upward slightly since the beginning of the year, but the gap is still quite high. So from a margin point of view, the banks are always going to still continue to do well, and especially as we've seen a flight to safety. So the big banks continue to get bigger, and if they become more efficient, then they'll get good numbers. But the question has always been the underlying economy, the key drivers of the economy, your breweries, your food and beverage companies, your construction companies, your cement manufacturers.
And we have seen good policies coming from the fiscal authorities, at least to support like the construction, supporting cement companies. We've seen that good.
Absolutely.
We've seen,
and I think that's the key. That's the key for us, is to say, look, the Monetary Policy Committee is almost obsessed with the currency and inflation. Growth has not played a big role in the direction that we've seen for interest rates. It's now a responsibility for government from a fiscal point of view to ensure that you don't stifle growth in the economy as a result of targeting these two items. And I think that that's what we expect more from the government. Just make it easier for businesses to thrive, make it easier for businesses to operate, give them all the incentives that's required to reduce inflation, to reduce unemployment in the market, which is a major problem in Nigeria. And I think that hopefully if all of those come together by early 2014, it becomes clear to the MPC that the direction for interest rates has to be
and all of that could, in a way, trickle down to, to market.
To the
all right.
market.
Thank you so much, Efemi. We're going to have to leave it there. Thank you for sharing your perspective on the market trading so far. Well, that has been Femi Olade, partner at Argentine Capital Partners, looking through the market trade. Now, that's where we'll leave it from Open Exchange.